Hello guys and welcome to the MagnetTrade. In this video, we'll discuss the difference between markets, the Forex, the stock exchange, the crypto, the commodities, and the futures markets. In the review, we'll include decentralization, how this market is designed, why people are interested in this market, major trading instruments within the market, and key drivers of instruments prices. At the end of every review, we'll grade each market by risk, accessibility, and volatility. Risk emphasizes how easily price can be manipulated, how influenced by news and governments this market is, and how stressful trading can be. Accessibility shows how easy it is to trade this asset in terms of time zones and physically owning it. Volatility emphasizes how many opportunities for potential profit and loss you get. At the beginning, however, I want to briefly mention what influences all markets. First, geopolitical events. Then, central bank policies, inflation and deflation, global economic data, natural disasters and pandemics, market sentiment and psychology. This is fear and greed. Currency movements. Since most global trade is done in a few major currencies, large movements affect all markets. Let's begin with Forex. The foreign exchange market, commonly known as the Forex market or FX market, is a global, decentralized financial marketplace where currencies are bought and sold. It's the largest and most liquid financial market in the world, with a daily trading volume exceeding $7 trillion. The Forex market is available worldwide. It doesn't have a central exchange. Instead, trading is conducted electronically over the counter across a global network of banks, brokers, and financial institutions. How is Forex market designed? Currencies are traded in pairs. For example, euro to US dollar, Great Britain pound to Japanese yen. The first currency is the base, and the second is the quote. The exchange rate tells how much of the quote currency is needed to buy 1 unit of the base currency. This is price of 1.1 means that for 1.1 US dollar, you can buy 1 euro. The pair follows the movement of the base currency. So, when it shows strength, it goes up, and vice versa, price goes against the quote currency, which means that when it shows strength, the pair goes down. There are numerous reasons why people are interested in the Forex market. Among them are high liquidity. With a daily volume of over $7 trillion, traders can enter and exit positions easily, even with large amounts. Low transaction costs. Typically, Forex trading costs are limited to the bid-ask spread. Commissions often very low or non-existent. Speculation and profit potential. Currency prices fluctuate constantly due to global economic and political events, creating frequent opportunities for profit. However, there are some controversies in it. 24-hour market. Open 5 days a week, 24 hours a day, allowing flexible trading across time zones. On the other hand, this can cause having overnight positions, which can be quite stressful because while you are sleeping, a guy from a different time zone can trade against you and steal your money. Leverage opportunities. Brokers offer high leverages, sometimes up to 1,000 to 1, allowing traders to control larger positions with relatively small capital. Sounds attractive, doesn't it? But no, this increases both potential profits and risks, and if you don't have sufficient risk management, you can get huge losses. Most trades are done in these major currencies: US dollar, euro, Japanese yen, Great Britain pound, Swiss franc, Australian dollar, Canadian dollar, and Chinese yen. Among key drivers of currency prices are interest rates, inflation and economic indicators, political stability, and geopolitical events. Let's grade it. Since Forex trading typically involves the use of leverage, it can be rather stressful, and because it works 24 hours a day, 5 days a week, you might have an overnight position, which can be even more stressful if the price goes against you. Also, Forex market is very influenced by the news. However, it's not likely to be manipulated due to high volatility and liquidity, which in fact gives a lot of opportunities for potential profit. Unlike the decentralized forex market, stock market is centralized in structure. Stocks are traded during workdays on organized regulated stock exchanges, main ones being New York Stock Exchange, commonly known as NYSE, National Association of Securities Dealers Automated Quotation, commonly known as NASDAQ, London Stock Exchange, Tokyo Stock Exchange, Frankfurt Stock Exchange, and Chicago Stock Exchange. All trades go through these central exchanges or electronic communication networks, which ensure transparency, regulatory oversight, and fair pricing. However, some off-exchange trading exists, particularly for small-cap stocks or unlisted companies. Why are people interested in the stock market? First are dividends. Some companies pay regular dividends as a form of income for shareholders. Note on dividends: if you are holding a short position, you will pay the amount of dividends to your company and not receive it. After the dividends, price usually immediately falls because the company pays money to its shareholders, therefore losing money. Sometimes, however, after a strong fall, price might not go further down because of dividends and might even go up. This happens because sometimes people hold more short positions than long. Therefore, company doesn't lose money but earns. Ownership and voting rights. Buying stock provides special ownership in a company and often voting rights on corporate matters if you own enough shares of a particular stock. Diversification. Stocks provide access to different sectors and industries, allowing risk diversification. Liquidity. Major stocks are highly liquid, allowing easy entry and exit at transparent prices. Retirement and wealth building. Stocks are central to long-term financial planning. On the other hand, there are some disadvantages. Market sentiment may overshadow fundamentals. Prices may be driven by speculation, fear, or hype rather than a company's actual performance. Dividend uncertainty. Companies can reduce or eliminate dividends at any time, especially in times of economic stress. Among major instruments are common stocks that represent ownership in a company and the claim on part of its profits, dividends. Stock indices and ETFs. Benchmarks like the S&P 500, Dow Jones Industrial Average, and Nasdaq 100 represent the market performance of several companies at once. Key drivers of stock prices. The main one is company performance. Dividends, earning reports, revenue growth, and profit margins directly affect a company's stock value. In the example, we can see that every time major statements happen or dividends are given, the price either falls or rises. Also, market sentiment, as we've just discussed, plays a huge role. And industry trends. Sector performance in general, for example, tech or energy, can impact all companies within that industry. Let's grade stocks. Stocks are less risky because they are mainly dependent on how well everything is going in the company and in their field. Also, they offer decent opportunities on a daily basis. And are traded only 8 hours a day, so you don't have to care about your positions at night. On the other hand, it can be a negative feature. They are traded during specific periods, depending on the primary exchange market, so trading American stocks in Asia can be rather uncomfortable. Cryptocurrencies are built on decentralized networks, primarily using blockchain technology. Unlike traditional financial systems that rely on central banks or authorities, cryptocurrencies operate on peer-to-peer networks maintained by miners or validators. Advantages are that no central authority controls the issuance or verification of transactions. Each participant has equal access to the system's history and logic. Decentralization also increases transparency, security, and resistance to censorship. Crypto technology is rather complex, and explaining it in detail would take another video, so we'll stick only to the main points. Cryptocurrencies are based on the following components: blockchain, a distributed ledger where all transactions are recorded in blocks that are cryptographically linked; consensus mechanisms, used to validate transactions without centralized control; proof of work, used by Bitcoin, involves solving complex problems; This is mining, competitive validation using computational power. Proof of stake, used by Ethereum, involves staking tokens to validate. Staking is locking coins to support network security. Smart contracts, programs that automatically execute actions when certain conditions are met, popularized by currencies like Ethereum. Wallets, digital tools, both software and hardware, that store private keys used to access and transfer cryptocurrencies. There are quite a lot of reasons why people are interested in cryptocurrencies: decentralization and autonomy, innovation and technology, interest in blockchain, DeFi, and Web3 applications, hedge against inflation. Some view Bitcoin and some other cryptos as safe haven assets, similar to gold, but this is a topic for another video. Stay tuned. Financial inclusion allows access to financial services without needing a traditional bank account. Anonymity and privacy. Transactions can offer greater privacy compared to traditional finance, though not fully anonymous. Global access and speed. Borderless transactions that are fast and often cheaper than traditional remittance systems. Among the controversies are speculative opportunities and very high sensitivity to sentiment and news. Actually, these 2 points aren't disadvantages if you know how to use them in your favor. Still, if you only begin trading crypto, these things can bring you problems. However, the fact that tokens with small capitalization can be crashed up to minus 99% by one person is a pure disadvantage. Key drivers of cryptocurrency prices: supply and demand. Coins with limited supply, for example Bitcoin's 21 million cap, get expensive as demand rises. Regulatory developments. Legal recognitions, bans, or taxation policies can heavily impact prices. Technological advancements, network upgrades, scalability improvements, or security features can boost investor confidence. Adoption and integration, used by businesses, payment processors, and integration into traditional finance. This is ETFs, crypto cards, obligation to pay taxes for crypto in some countries. Among major instruments are coins, mainly Bitcoin, the first and most well known. Ethereum supports smart contracts and decentralized apps. Then, altcoins, BNB, Solana, and Dogecoin. Stablecoins, cryptos pegged to fiat currencies, USDT, this is Tether, and USDC. Also tokens, they are built on top of other blockchains, used in DeFi platforms, games, and NFTs. And NFTs are unique digital assets representing ownership of digital art, music, collectibles, etc. Crypto is rather risky, except for Bitcoin as mentioned earlier, due to low market cap and high volatility, very influenced by news and improvements in the technology. Also, it works always, which is as usually can be stressful, but in case of crypto, it's considered to be one of the main advantages comparing to conventional financial instruments. The commodities market is partially decentralized depending on the segment. Physical commodities markets, for example, local agricultural trade, mining operations, are relatively decentralized with numerous producers and buyers across different regions. Financial commodities trading on exchanges like SME or ICE is centralized with prices determined by open market trading through regulated exchanges. Commodities trading is globally integrated, but regulation and logistics remain region specific and sometimes politically influenced. The commodities market is structured in two main layers: spot market, physical market, and derivatives market, futures and options, that are traded on exchanges and clearing houses. People are interested in commodities due to inflation hedge. Physical assets like gold, oil, and agricultural products tend to retain value during inflationary periods. Hedging by producers. Producers, for example, farmers, oil companies, and consumers, for example, airlines, manufacturers, use commodity futures to hedge against price fluctuations. Portfolio diversification. Commodities have low correlation with stocks and bonds, making them ideal for risk diversification. The best example is gold, which is the most well-known safe asset. Global economic exposure. Commodity prices reflect the health of global supply chains and macroeconomic trends, offering investors insight and leverage. Speculation and profit opportunities. Price volatility, driven by supply and demand shocks, geopolitics, and weather, creates short term trading opportunities. The main commodities are typically divided into four categories: energy, metals, agriculture, and livestock. Energy commodities include oil and natural gas, which fuel industries and transportation. Metals like gold, silver, copper are essential in manufacturing and electronics. Agricultural commodities cover crops such as wheat, corn, and coffee, etc. Lastly, livestock includes animals like cattle and hogs. These commodities are traded globally and play a crucial role in the world economy, influencing prices and availability of everyday products. Among the key drivers are weather patterns, supply and demand changes, and geopolitical events. Commodities are probably the least risky assets and usually follow yearly patterns. Still, they are rather volatile, highly influenced by news and geopolitical relationships. For example, current intergovernmental agreements caused the price of oil to decline. This market is the least accessible because physical commodities are quite difficult to obtain, and on the market, futures of commodities are usually traded, which we are going to discuss now. Futures are one of the most potentially lucrative and popular assets because they allow traders to speculate on the future price of commodities, currencies, or financial instruments with high leverage and liquidity. A futures contract is a legally binding agreement to buy or sell an asset at a predetermined price on a specified future date. These contracts are widely used for both hedging and speculation. For example, an investor can profit from price movements in oil, gold, or stock indices without owning the physical asset. Also, futures usually work close to 24 hours, and for major indices, they follow pre-market, which helps active traders to follow news and open a position before the cash market opens. Note that crypto futures are used to speculate without influencing the price movement yourself, so that when someone wants to invest huge sums of money with leverage, it doesn't double the price of a coin. However, while the profit potential is high due to price volatility and leverage, so is the risk of loss, especially for unhedged or leveraged positions. So guys, we've evaluated all the key points, but I want to emphasize that every market provides lots of opportunities and there is no best market. Each of them has unique patterns, indicators, advantages and drawbacks. Thanks for your attention. Write down in the comments just what should I make next video about. Like and subscribe. See you in the next one. Goodbye.